Studio guest this morning, and we are talking to this morning Guirguis and Gibbs. And I want to see if I can get this right. We have Amy Gibbs. Did I get Amy nice and close to that mic, as close as you can get? Okay, so we can hear you. I did get it right.
You got it right.
Okay, because sometimes I roll the dice and I get it wrong. So you must be Mark Guirguis.
That is correct.
Okay, and you have. Is it fair to call you tax accountants? Just accountants? How are we looking at
all of the above?
All of the above. So give us a little overview of what you guys do at Guirguis and Gibbs.
We do everything that a client needs: payroll, bookkeeping, taxes, tax planning, business setup. We even handle investments.
So if I wanted to, when you say investments, does that range anywhere from like a 401k,
401ks,
to
retirement,
all of that stuff, and you will tell us where to put our money?
Education planning, individual planning, and we do this through our broker-dealer, Cetera Financial Services.
And is that what you, Amy, is that what you specialize in?
You know, we both do. We overlap a lot of our services, although we do have our strong areas.
Oh, okay. So if I were to come to you, what do you specialize in?
More of the retirement planning and any kind of education planning, insurance, life insurance. Mark gears more towards IRS issues, setting up businesses, figuring out the right type of entity for your business.
IRS issues, when I hear the word IRS or the initials IRS, Internal Revenue Service, the first thing I think everyone thinks of is that dreaded word audit. Is that what you handle?
Funny you mentioned that. Mark has a whole paragraph about this. So he's going to touch on that this morning.
Oh, okay. So talk to me about audits.
So audits, this is going to be a really big topic going into 2024. There's three main areas we're kind of looking at. So far, exactly. There's always going to be more, right? The first big audit that is already starting to happen has to deal with the employee retention credit. And for, everybody listening, you probably heard the radio commercial, seen it on TV, even get an email saying,
postcards.
If you employed X amount of people during COVID, you can earn up to $26,000 per employee. And it comes
as a business. Okay, so I know you guys know a lot of stuff, but you got to talk to me like I'm five.
Down.
Yeah. So an employee tax, so just break that down a little bit for me. So you're talking about small businesses.
Correct.
Will get this tax credit.
Correct. It's been advertised. Mainly the focus is you're going to get this money back. And the way the advertising is geared isn't really telling the whole truth.
Mm-hmm.
Well, that's because there are services that are out. And what they don't tell you up front is they're going to take a piece of your refund. That's how they earn money.
Sure.
So they basically advertise this like everybody's eligible. And that's not true.
Okay. And how do we know if we are eligible or not? Because I would see that if I was a business owner.
It sounds appealing.
Oh, hello. Yes, absolutely. So what do we do?
Well, the biggest thing, kind of going back without diving too deep into the criteria, is for most people who actually did accept it and didn't go through the rigorous process of being approved and everything else, if you get a nice little love letter from the IRS that's saying, you took the employee retention credit, you got this money from the U.S. Treasury, we're going to audit you. And
let's talk about why, if we
exactly.
can. What they don't tell you in these advertisements is that you cannot double dip. You cannot take the payroll expense and additionally get the credit. So what happens is if you own a business and you choose to take this credit, you have to go back and amend all those payroll tax returns that you took the expense on. And you also have to amend your business return, which in many cases will affect your personal return, which again, in many cases will cause you to owe money to the IRS.
I already have a headache. I don't know how you guys do this. I already have a headache.
It's a big puzzle. And if the IRS were to audit people,
Mm-hmm.
they want to see, did you file those amended returns correctly? Did you pay that additional tax that's going to be owed? Are your accounting records up to date? So they're going to come in and start dissecting because it's money in a form of a credit that they gave you, and they want to know if you truly deserved it based on proper criteria and eligibility.
Mm-hmm.
So because
Well, we are hearing stories that people did
Yeah.
dip and some didn't need to dip
correct.
and dipped hard.
I blame a lot of that on the people that are soliciting these services. They're not telling the whole story because they're not tax professionals.
Mm-hmm.
So I tell
Well, then if they're not tax professionals, what?
they're salespeople. They're glorified salespeople. What I would recommend to everybody, if you're interested in this credit, before you sign anything or agree to anything, talk to your accountant.
Okay.
And if you don't have an accountant, you can contact us
Uh-huh.
at 661-209-3287. But I definitely recommend that you talk to your accountant before you proceed.
Are there we started talking about these audits, and I think you said there were three different things we need to be aware of. So that's the first.
That's the first.
That's
what
a
else?
good one.
Mhm.
The second one, which has been kind of mulled about, but we're going to start seeing it happen more, are residency audits. Because people are either in the boat of thinking about leaving California or have already left California, or for any listeners, they know somebody who's already left California. And what these residency audits are going to do is, again, you'll get a nice little love letter, this time from the state of California, saying that they selected you for residency audit because you left the state.
May I expand on
Of
that?
course.
The reason they're doing this, if you've lived in California more than 10 years,
Mhm.
they want to tie you to California forever. So what they're doing is people are leaving California by the droves. We have a good percentage of our client base that have moved to Tennessee, to Nevada, to Arizona, to Texas. They've just been fed up with California. So with all these taxpayers leaving, that's going to leave us in a default. What they're doing is if you want to leave California, you've got to cross all your T's and dot all your I's. What does that mean? That means get rid of all of your California bank accounts, retirement accounts in California. Get rid of your driver's license from California as soon as possible. They have advised us that they're going to go as far as see if you have any doctors still left in California or even a veterinarian. Can you imagine that? If you still have a veterinarian in California, they're going to try to tie you to California.
Well, I mean, you wouldn't if you're moving. Why would you be tied to?
One would think.
You would need to find a new doctor for your pet. I mean, it doesn't seem very likely that you would still be tied to a veterinarian.
But sometimes people have rental properties in California or family in California, so they might leave those doctors open. The bottom line is to not be a resident of California. These are the methods that you have to take to show that you are no longer tied to California.
Well, I'm sure it's happening in other states as well. I mean, we're talking about residency in California, but what about the opposite, coming back into California, people moving from New York to California? I have several friends who've now moved from New York to California. I'm sure they're experiencing the same thing as well.
So far, what we know is the residency audits are going to be from California. I think California is almost like the guinea pig of this kind of thing. And if California can collect some of that lost tax revenue for the people that left, I'm pretty certain other states are going to really start catching on and say, hey, this is a way we can increase our tax revenue. Let's see who left New York and moved down to Florida because they got so tired of the taxation. So I anticipate other states might jump on this soon enough.
And in the time we have left, which we don't have a lot of time left, what's the third? You said there was a third thing.
Just individual audits are starting to ramp up in general. The IRS recently came out with a report that said over the last 2 years, they lost about $668 billion in tax revenue. So the way they think is we're short tax revenue. Hey, people aren't paying their taxes. So what are they doing? They're hiring auditors and collectors, and they're going to start scrutinizing tax returns very closely.
Well, they're trying to recap all of that money given out for the stimulus payments and various other money that was funded during COVID, the president doubled their budget for hiring people.
Well, I mean, I see it. I do see it a lot. There are a lot of people out and about who cheat on their taxes, and they cut corners. I see it a lot, and I see a lot of people also, having their own business to try and, their own incorporated business, trying to get through loopholes. And so it does happen, and it happens quite often. So I'm assuming they do need to collect on, revenue that has been
Keep
lost.
in mind, we've been at the lowest audit rates since 1942. So they have found that it's time to start auditing the public.
Mm-hmm.
And it's happening. It's already started.
Mm-hmm. Which is, I guess, a good thing for Mark if he's an expert in audits.
I like to put on the boxing gloves and fight with the IRS and the Franchise Tax Board. I do it enough.
He's done very well.
And I do pretty well at it because I feel like we always have to be 2 steps ahead of them. And we ultimately try to use their rules and their laws against them to come to some sort of amicable agreement or get the issue thrown out altogether. So,
but you do see where we have to abide by the guidelines
Correct.
set up by the
governing agencies.
Yeah, I mean, we shouldn't be cheating. We shouldn't be. There's
a difference between being cheating and finding that fine line not to cross over. Being aggressive is okay as long as you can support it. Cheating is a whole different story.
Mm-hmm.
So I feel that everybody should get everything that they deserve, every tax write-off that they deserve.
Absolutely.
Without crossing the line.
Absolutely. I believe that as well. All right. Well, we have run out of time like over and over again. So I do have to wrap this up.
This happens every time we're here.
Guirguis and Gibbs, what is the best phone number, or do you want a website? What's the best place to get?
You know what? There's
you?
2 ways to reach us: 661-803-9984. And then our website is gginctax.com.
Repeat that again, Amy.
gginctax.com.
Excellent. Excellent. And you can always call here at the station. If you're driving around and you didn't get to write any of that down, we can give you that information as well. Thank you, Amy and Mark, for being here. I appreciate it.
Thank you for having us.
And we're just the tip of the iceberg. A lot of stuff going on in the tax world.
There's a lot to discuss.
There's more to discuss next time.
Quite a bit.
And I will bring Advil next time, for sure. Have a great one.
You too.